In the world of finance, logic often bows to sentiment. And on June 20th, 2025, the Indian stock market provided a masterclass in this very principle. While headlines were dominated by simmering geopolitical tensions between Israel and Iran, a development that typically sends shivers down the spine of global investors, Dalal Street chose to dance to its own optimistic tune. The day ended not with the anticipated caution, but with a resounding roar of the bulls. It was a classic case of domestic strength and specific market dynamics overshadowing international anxieties, leaving many traders who had bet on a downturn scrambling to understand the sudden and powerful shift in momentum. The numbers themselves painted a picture of unbridled optimism and a decisive market recovery. The benchmark S&P BSE Sensex, a barometer for the health of India's top 30 companies, rocketed up by an impressive 1,046 points to close firmly at 82,408.17. Its counterpart, the broader NSE Nifty 50, was not far behind, gaining a substantial 319 points to settle at 25,112.40. This broad-based rally wasn't confined to the blue-chip giants. The positive sentiment cascaded down to the wider market, with the BSE Mid-Cap Index climbing by 1.2% and the BSE Small-Cap Index adding a respectable 0.55%, signaling widespread investor participation. This surge translated into a significant wealth creation event for investors. In a single trading session, the total market capitalization of all firms listed on the Bombay Stock Exchange swelled by approximately 5 lakh crore rupees. This staggering figure underscores the sheer force of the buying frenzy that gripped the market. The rally was particularly noteworthy because it came after 3 consecutive sessions of subdued range-bound trading. The market seemed to have been coiling like a spring, and on this Friday, it finally released its pent-up energy, defying the gloomy global backdrop and charting its own course toward new heights. The key question on every investor's mind was simple: why? Why did the market choose this particular moment, amid such pronounced global uncertainty, to stage such a spectacular comeback? The answer, as is often the case in complex market environments, was not a single overarching reason, but a confluence of several powerful domestic factors. These included technical market adjustments, a favorable turn in commodity prices, and a renewed vote of confidence from foreign investors. Together, these elements created a perfect storm of positive catalysts that proved strong enough to neutralize the fears emanating from the Middle East for a day. Section 2. The mechanics of the rebound, short covering and technical plays. One of the primary technical drivers behind the remarkable surge was a phenomenon known as short covering. In simple terms, many traders had previously bet that the market would fall due to the geopolitical tensions and recent sluggishness. They did this by short selling or selling stocks they didn't own with the hope of buying them back later at a lower price. However, when the market started to rise instead of fall, these traders were caught on the wrong foot. To limit their mounting losses, they were forced to buy back the shares they had sold, and this rush of compulsory buying created a powerful upward thrust, accelerating the rally even further. This short covering was not happening in a vacuum. It was fueled by a renewed sense of confidence in the underlying strength of the Indian economy. After a few days of consolidation, valuations on many quality stocks had become more attractive. Investors who had been waiting on the sidelines saw this as a golden opportunity to enter the market at slightly lower levels. This dip-buying mentality provided the initial spark that ignited the short-covering fire. The market had effectively shaken off the pessimists and attracted the optimists, leading to a powerful bounce-back that broke the recent spell of indecisive sideways movement. From a purely technical standpoint, the market was operating within a well-defined trading range for several sessions. Traders and analysts were closely watching key support and resistance levels. A decisive break on either side was expected to dictate the market's next trend. On June 20th, the Nifty 50 decisively broke above its immediate resistance levels, triggering a cascade of buy orders from technical traders who follow chart patterns. This breakout was seen as a strong signal that the period of consolidation was over and that the market was ready to resume its upward journey. encouraging more participants to join the rally. Market experts pointed to this technical setup as a crucial element of the day's events. Ajit Mishra, a respected analyst at Religare Broking, noted that a conclusive move above the 25,200 mark on the Nifty would officially end the consolidation phase and open the doors for higher targets, possibly in the 25,600 to 25,800 zone. Similarly, Rupak D of LKP Securities highlighted the importance of the Nifty reclaiming its 21-day exponential moving average, a key short-term trend indicator. Surpassing this level, he explained, gave the bulls the technical ammunition they needed to push the market higher with renewed confidence. Section 3. Fueling the fire. The positive impact of falling crude oil. Another significant tailwind for the Indian market came from the global commodity markets, specifically the price of crude oil. On the same day, Brent crude, the international benchmark for oil prices, experienced a notable decline of over 2%. For a nation like India, which is one of the world's largest importers of crude oil, a drop in oil prices is almost always welcome news. It is akin to getting a discount on a massive essential national expense. This development provided a strong fundamental reason for investors to feel optimistic about the country's economic outlook, independent of the stock market's technical movements. The reason for this price drop was twofold. Firstly, some of it was attributed to simple profit booking by oil traders after a recent run-up in prices. Secondly, and more importantly, the United States signaled a cautious stance, indicating it was not rushing to get directly involved in the Israel-Iran conflict. This tempered fears of a wider, more disruptive war in the Middle East that could severely impact global oil supplies. The easing of these specific fears led to a welcome correction in crude prices, providing immediate relief to major oil-importing economies like India and China, and thereby boosting investor sentiment. Why does this matter so much for India? Lower crude oil prices have a cascading positive effect on the Indian economy. They help in reducing the country's import bill, which in turn strengthens the Indian rupee against the US dollar and helps keep the current account deficit in check. Furthermore, cheaper oil translates to lower input costs for a wide range of industries, from transportation and logistics to manufacturing sectors like paints and chemicals. This can lead to better corporate profit margins, which is a direct positive for stock valuations. It also helps in keeping inflation under control, giving the Reserve Bank of India more room to maintain a supportive monetary policy. Therefore, the slide in oil prices acted as a powerful psychological and economic booster for Dalal Street. It gave investors a tangible reason to look past the geopolitical noise and focus on the improving domestic economic landscape. This fundamental positive factor provided a solid foundation for the rally, assuring market participants that the day's gains were not just built on speculative short covering, but were also supported by a favorable shift in macroeconomic conditions. It reinforced the narrative that the Indian economy remains resilient and is well positioned to benefit from favorable global commodity cycles. A critical piece of the puzzle explaining the market surge was the renewed buying interest from foreign portfolio investors, or FPIs. These large institutional investors, who manage vast pools of global capital, had turned net buyers for the third consecutive session, signaling a significant shift in their sentiment towards India. On the preceding day, June 19th, provisional data showed that FPIs had invested a net amount of 934.62 crore rupees in the Indian cash market. This consistent inflow of foreign money provided much-needed liquidity and acted as a major confidence booster for domestic investors who often take cues from the actions of their global counterparts. This return of foreign capital was closely linked to movements in the global currency markets, particularly the US dollar. The US dollar index, which measures the greenback's strength against a basket of major world currencies, had been showing signs of weakness. A softer US dollar typically makes emerging market assets, including Indian equities, more attractive for foreign investors. When the dollar weakens, investors can get more Indian rupees for their dollars, effectively making their investments in India cheaper. This currency advantage, combined with India's strong growth story, created a compelling case for FPIs to allocate more funds to the Indian market. The consistent buying from FPIs is often seen as a seal of approval for a country's economic management and future prospects. When these sophisticated, well-researched investors choose to deploy capital, it suggests they have a positive long-term outlook that looks beyond short-term geopolitical jitters. Their return to the buy side helped to absorb selling pressure and create a stable base for the market to build upon. This flow of smart money is crucial because it not only lifts benchmark indices but also improves overall market depth and stability, making it a more reliable and attractive investment destination for all. In essence, the FPI's actions on June 20th were a vote of confidence in India's relative strength in the global economic order. While other regions grappled with uncertainty, India's robust economic growth forecasts and ongoing reform agenda presented a beacon of opportunity. The combination of a favorable currency exchange rate and strong underlying fundamentals proved irresistible. This flow of foreign investment was the third critical pillar, alongside short covering and falling oil prices, that supported the market's spectacular one-day rally, turning a potentially nervous trading day into a celebration of India's economic resilience. As the dust settled on a remarkable trading day, investors and traders began looking ahead, seeking guidance on whether this rally was a one-day wonder or the start of a new sustainable uptrend. Top market experts largely concurred that while the surge was impressive, caution was still warranted. Avinash Gorakshkar, a prominent SEBI-registered analyst, suggested that much of the rally was driven by short covering, which was itself based on hopes of a de-escalation or a truce between Israel and Iran. He implied that if these hopes do not materialize, the market could quickly give back some of its gains, reminding investors that the rally's foundation was partly built on fragile optimism. For active traders, technical levels have now become more important than ever. The focus has squarely shifted to the Nifty 50's ability to conquer and hold the crucial psychological and technical milestone of 25,200. As highlighted by Ajit Mishra of Religare Broking, a decisive close above this level would be the confirmation the bulls are looking for. Such a breakout would signal an end to the recent consolidation and could pave the way for a further rally towards the 25,600 to 25,800 zone in the near term. Conversely, failure to cross this hurdle could see the market slip back into a range-bound state. On the downside, a key support level to watch is 24,850. According to Rupak D from LKP Securities, this level acts as a critical floor for the current market structure. As long as the Nifty remains above this mark, the short-term sentiment is likely to remain positive or neutral. However, a break below 24,850 could signal that the bears are regaining control, potentially triggering a fresh wave of selling. Traders are therefore advised to monitor these two levels, 25,200 on the upside and 24,850 on the downside, as they will likely dictate the market's direction in the coming sessions. In conclusion, while the surge on June 20th, 2025 was a welcome development driven by a potent mix of short covering, falling oil prices, and FPI inflows, it is crucial for investors to remain vigilant. The market's direction remains heavily dependent on the evolution of geopolitical events, the trajectory of crude oil, and the continued flow of foreign investment. The rally has provided a clear roadmap with defined technical levels to watch. As always, investors should exercise due diligence, verify information from multiple sources, and ideally consult with a certified financial advisor before making any investment decisions in this dynamic and ever-changing market environment.